We are off to the races. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming off a slowdown in consumer prices bolsters bets or brings bets back that the Fed will be able to cut rates. Earnings season kicks off with JP Morgan, Goldman Sachs, and Wells Fargo all reporting robust results, to say the least. And BlackRock pulls in a record $641 billion in client cash last year, with Larry Fink saying that is just the beginning. Let's take a look at where markets are trading, with futures up bigly, looking at 1.5% gains on S&P futures. NASDAQ futures up 1.8%. The reason is right there. The 10-year yield coming down after CPI missed estimates. It was cooler than had been anticipated, and that means that investors can start betting on Fed rate cuts again, to the extent that they were before. Sonali, it was a number that I think the entire newsroom and all of Wall Street was watching.
My anxiety levels were through the roof this morning when we were at 476. Now we're at 467. We can all sleep easy. Although you might not want to be asleep, because some stocks are just ripping along with the market here, and you can see it in the banks. The trade just building all morning. JP Morgan blew past estimates after its trading desk notched a record fourth quarter. Election swings had something to do with that. Citi is buying back $20 billion in stock. Wells Fargo sees net interest income rising around 2% for the year. Goldman also just soaring, traders beating expectations, and the stocks, as you can see, all up bigly as well. I'll look at some of the banks reporting tomorrow as well. Morgan Stanley, Bank of America also already showing some love on the screen here. Big trading desks here. Investment banking rebound. We'll watch for net interest income over at Bank of America. Lazard. Also, with that investment banking rebound at the other banks, you're seeing Lazard stock rise in synchrony, up about 8.6% pre-market. BlackRock, Mr. Larry Fink saying, of course, that yes, this is just the beginning. Record client cash inflows for 2024, 11.6 trillion in assets under management. We're just shy of expectations. So you could see, Matt, expectations are still high after a banner year.
Yeah, and I mean, I think the inflation report, the effect of that can't be understated. We saw a super core that came in at the lowest level in, I would say, almost a year here, since July, in terms of the month-over-month super core. This means that investors who are psyched about tax cuts and deregulation can also be psyched about Fed rate cuts. And that's really what this market needed, because for the past couple of weeks, we were freaked out that inflation was going the wrong way.
Yeah, I was really struck by Larry Fink's comment this morning that you could see the 10-year go to 5.5%. We were looking at that together right before that inflation data came out.
That's not so shocking, right?
Not so shocking when we were flirting with 4.8%. But now, as you say, we're comfortably below 4.7%. All is well in the world.
Let's find out how well all is right now. We'll bring in Michael McKee. He is our international economics and policy correspondent. Mike, what was your read on the cooler inflation numbers that we got?
Well, it was a reasonably good number. It's not an excellent number. It doesn't bring inflation down any really closer to where the Fed wants it to be in terms of the CPI. The real question is how about the PCE at the end of the month, and CPI and PPI in now. We'll get some numbers on that from the Economist in a little while later today. But the thing to look at is the headline number came in bang on expectations, 0.4%, but the core up just 0.2, which pushed core CPI down to 3.2%. That's the lowest since August, and it is a little bit of progress. Gasoline prices went up. You knew that. Natural gas, no surprise, it's been cold. Airfares, a big contributor, not as much as in PPI yesterday, but they were up 3.9%, and used car prices continued to rise. What went down? Eggs, medical care, health insurance and apparel, some of those things feed into the PCE. The thing you want to look at politically, eggs, of course, up only 3.2% compared with 8% the month before. Seems like Joe Biden solved that problem before he left office. The inflation measures that I mentioned, everybody's looking at is PCE because that's what the Fed's going to make its decision on. And we have to wait and see how all this fits in, the people who crunch the numbers doing that. But what we have seen so far is PPI and CPI in the last couple of months pulling that inflation number, the PCE one, the yellow line there, up. And that's not what you want to see. If that gets closer to 3%, people have talked about, well, then the markets are going to start anticipating a rate increase. So if these numbers help push that down, that would be good news overall for the markets. But what's interesting is you mentioned we're in good shape now, at least for 24 hours, because what ends up happening is every little thing gets traded on, and the big thing doesn't happen until next Monday. So let's see where we are on Tuesday and Wednesday of next week. But for right now,
are you talking about the college football playoff?
Exactly. Right now,
Very
where
cute.
we are, you look at Fed funds futures, and
Go
we saw
Buckeyes.
them.
I'll watch with
We
you.
saw a big move. Everybody was pricing in a September move as the first one. Now we get a July move as the first one, and this just shows that, as you mentioned, the markets are very, very sensitive to every data point at this point.
Data points, events, inauguration, all of the above. First 100 days. Michael McKee, we thank you so much for joining us. We're excited for the next set of data because, of course, everything always changes and then the next one drops. Turning now to the banks, JP Morgan trading blew past estimates, while Wells Fargo sees net interest income rising up to 3% annually in 2025. Bloomberg's Sridhar Natarajan joins us. One thing that struck me about the results is in addition to Wells Fargo raising the bar on net interest income, they're also recording severance costs. But you look elsewhere, you have Citigroup narrowing the profit target range. You have Goldman saying headcount increased, but operating expenses decreased. It looks like the banks, speaking of inflation, are ready to tell investors, let us spend some money here so we can keep growing faster.
And I think when they talk about the catalyst of what lies ahead, both in terms of improving CEO confidence and what that means for deal-making activity, what their biggest clients in terms of the biggest buyout firms do, and the fact that they are increasing activity, and the very obvious likelihood that some of these onerous regulatory proposals get rolled back or not get implemented, that is going to measure good news for banks going ahead.
So Jamie Dimon mentioned the two big risks. Inflation is one that we, I guess, have dealt with pretty thoroughly now. And geopolitical risk, war is another, right? Hopefully part of that gets solved soon as well. Is this going to be a banner year for these banks?
It's setting out that way. If you look at the run-up in all their stock prices heading into year-end, that is what it certainly augurs for the banks ahead, because the stocks will not be up 30, 40, 50% if you're not expecting a really good 2025. But banks are out there to tell you, not just are they going to have a good year, it's going to be better than what you're expecting, because we're still not close to seeing some of those long-term averages when it comes to all of that deal-making activity. And already in the first week of this year, we have seen enough signs that people are ready to go out and transact. Speaking
of people going out and transacting, it means that you got to make your people happy. I'm looking at the headline from this morning, Apollo, promoting Jim Zelter, John Zito getting a promotion as well. These are people who have led their credit businesses for a very long time. What does this mean? You also had changes at JP Morgan, people being elevated. You have somebody very senior leaving BlackRock. What is happening under the surface right now? It's very interesting. We've had a very busy 2 days when it comes to some of the biggest firms that we care about. JP Morgan, obviously, we saw the changes with the new CEO, and we were wondering what that means for succession. Didn't get much clarity. Yesterday, Mark Wiedman left BlackRock. That is important because he was seen as one of the likely successors to Larry Fink. So there we're still trying to figure out is, does Larry Fink have someone within the BlackRock stable that he could tap, that his board could tap and elevate to be his successor? Or will he have to look outside the firm? And now at Apollo, this one's interesting because just a few weeks back, Mark Rowan was in the news about a potential role in the Trump administration. That obviously set out a lot of conversations and questions from investors and analysts. Now, with them indicating that Mark Rowan will extend his contract for 5 years, that means he's going to be in that spot.
The next generation is elevated. They've created a new role for Jim Zelter as the president of the entire firm and elevated John Zito, who's had a super successful run running and shepherding the credit business at Apollo in recent years. And that, of course, is a big money spinner for Apollo.
It's very possible John Zito is your next CEO of Apollo after several years, if Mark keeps leading for a lot longer.
Well, he's a pretty cool guy, so we're excited about that. Shri, thanks very much. Sridhar Natarajan talking to us about the banks. We are now joined by BMO Private Wealth Chief Market Strategist Carol Schleif. Carol, what do you make, first off, of the slightly cooler inflation numbers that we got today? I know 1 month does not make a trend, but the markets are reacting very positively.
Clearly, the markets are relieved by the numbers, and I have to admit, I agree with you too. I'm relieved too. Came in with very high anxiety this morning looking at the number, but it's really important for investors to put into context the fact that all of these numbers that we're hanging all of this anxiety on are backward-looking numbers. And there's a lot more important stuff coming out. You've talked about the bank earnings. We get the beige book. We really have to look at the underlying economic fundamentals, and they're chugging along pretty nicely. And the fact that they're in balance is pretty nice. You know, we've still got inflation running above where the Fed says its target is. But when you look back over decades, the long-term average of inflation is closer to 3.5%, 3.8%. And so figuring out, that's what both stock and bond markets are trying to figure out, is what does that new normal look like? Does it look like the last 20 years, or does it look like the 40 or 50 years before that? And our suspicion is it looks like before that we're not going back to 0% kinds of normal rates, but rather those low single digits. Is it 2% or 3.5%? It's someplace in there, and we're moving into that range.
Carol, you know, it's interesting. I think I drive Matt crazy because even when all the data is great, I look for the bad things just to keep an eye on risk. Does it bother you that headline inflation is not as promising as what you saw in core?
Yeah, there is that piece of it, and it's also important to remember that a lot of what drives the core, when you think about insurance costs, airline flights, used car costs, those things are going to stay sticky for some period of time. Look at the housing market too, or look at even the pressure that's been put there. We had the Fed cut 100 basis points, and yet we've added 100 basis points to the 10-year. During that time frame, and that's what mortgage rates are tied to. So there's still some stickiness in the economy. But that said, animal spirits are at least purring in the background, if not getting ready to roar. You're seeing the banks structure themselves, getting ready to participate, hopefully in lighter regulatory touch, more ability to do M&A and IPO, and that's really solid for underneath. So whether or not we hit the Fed's target of 2%, we think that focusing on the economic fundamentals and the way this thing plays out are what investors should be focused on.
There's been a couple of reports over the past few weeks, Carol, that Trump's tariffs are going to be more gradual or lighter than, you know, the bluster on the campaign trail. I don't know if that's just because media is obsessed with Trump's tariffs or because it really matters to inflation figures. How do you see it?
Well, I think a piece of it is it's important to remember it's not just tariffs. There's a whole bunch of policies. The interesting thing is having markets closed on Monday, and I suspect there's going to be a lot of announcements out on Monday. So it's really a buckle up and get ready for what comes in the next week or so. But tariffs it depends on how they're deployed. They're not just a market obsession. Trump has clearly voiced preference for using tariffs in a variety of factors. There's the across-the-board tariffs. There's also tariffs to elicit a certain response from various trading partners. And so there's a variety. Figuring out how they're implemented and watching will be important. But I also think it's important, too, to realize that tariffs in a Trump 2.0 presidency aren't necessarily similar to Trump 1.0, because coming through the inflation scare that we have, if tariffs are applied more broadly towards consumer goods, it's going to be tough for those importers to pass those along because consumers are so resistant to inflation. And so there'll be some absorption, I think, in margins in the companies, because tariffs realistically are a tax on whoever's bringing the goods into the United States. And that entity has to figure out how they're going to how they're going to deploy them, whether it's through margin enhancement internally or passing them along.
Carol, one thing about bank earnings is that it's kind of like the unofficial start to earnings season. There's some that come before, but this really kicks off the wave. Fair to say they were pretty blockbuster. And if you think about what we might see ahead of us in terms of earnings, do you think that the rest of corporate America will follow suit?
We do think you'll see a broadening in the earnings health. You've had technology earnings that have been gangbusters, especially in a narrow set for a very long period of time. But you're starting to get base effects there where it's hard to grow at those rapid double digits on top of the rapid double digits you've been growing at. But you're seeing more and more optimism and more opportunity for those mid and small cap stocks and the other 493 S&P 500 companies. You're seeing it in market reaction today. The bank stock earnings and the more muted CPI are really driving the Russell 2000 and the S&P 600. Those smaller companies are participating. And we think you'll see solid upper single digits, lower double digits in aggregate of earnings across those companies.
All right, Carol, great talking to you this morning. Thanks so much for joining us on CPI Day. BMO Private Wealth Chief Market Strategist Carol Schleif talking to us about these markets and the reaction. We have futures rising. Coming up, Baird Senior Analyst David George will give us his reaction to the bang-up numbers from JP Morgan. This is Bloomberg.
Checking in on shares of JP Morgan and Wells Fargo, where there has been a trade building all morning long. You're now JP Morgan up about another 1.3%. This, Matt, is a bank already trading well above 2 times book. Wells Fargo almost 5% higher, touching that mark. Got a lot of other banks also that are rising in synchrony. Now, Baird Senior Research Analyst David George has an underperform rating on JP Morgan, a neutral rating for Wells Fargo. He joins us now to discuss. It's interesting to see Wells Fargo raise the bar on net interest income. JP Morgan, when you read through their presentation, they told investors here that they're going to be spending more on bankers, on advisors. They're looking for growth. But how much more upside is there after such a large rally, particularly since the election?
Yeah, good morning, Sonali. It's good to be with you this morning. So yeah, from our perspective, the numbers from both JP Morgan and Wells were very good. I think expectations were anchored a little bit down given the pullback in the banks and the market over the last couple of weeks. So the stocks, I think, have been de-risked a little bit going in. So between that and a benign CPI this morning, I think it's reasonable to expect a lift in the banks today. From our perspective, Wells probably has a little bit more upside because the stock is cheaper. JP Morgan is over 2.5 times tangible book. Wells is closer to 1.5 times. And Wells is actually, as you mentioned, Sonali, guiding to more upside in net interest income relative to JPM. And to your point, JPM, and this is not surprising, JPM, one of the reasons why they have done so well for so long is they have consistently invested in the franchise through adding bankers, adding verticals, adding technology, investing in IT to give them the ability to grow. They're also, since they cannot really do any meaningful deals, they're continuing to invest, and that expense growth should over time result in better revenue growth as well.
You know, one thing that a lot of investors think on first blush is that you look at that rise in net interest income expectations from JP Morgan and Wells Fargo, and that there could be a read-through across the banking system or something like that. Do you think that the regional banks will get as lucky when it comes to more lending profits here just because rates have not fallen as much as expected?
Yeah, so I think both JP Morgan and Wells Fargo is what we would characterize as higher for longer stocks. So a Federal Reserve that is not poised to cut relative to expectations maybe a month or two ago. Wells, JPM, and B of A, I think, are more beneficiaries relative to the regionals. However, today's reports clearly, we think at least, are good news for regional banks. Keep in mind, regional banks are 70 to 75% driven by net interest income relative to the money centers, which are much closer to 50 to 55%. So this should bode well in addition to today's CPI number, should bode very well for regionals. We would actually expect the regionals to outperform the likes of JP Morgan as trading starts here in a few minutes this morning.
Well, and you have a big coverage universe, David. I'm just looking at at least 18 companies that you cover. Those regionals are the ones you like the best: Citizens, M&T, PNC, Comerica. Why is it that you like them so much better? You don't have any outperforms on the big money center banks. So why is it that you like the regionals so much better?
Yeah, it's a couple things. So so first of all, it's an expectations gap differential is what I would characterize it as, Matt. Post-election, we saw a big move in the money center banks on the expectation of higher fees, higher capital markets activities, et cetera. And that is a very reasonable expectation. But the street already took up numbers for capital markets and expectations from a valuation perspective for 2025. So whereas on the net interest income side, we think there's actually significant upside coming for the regionals as banks continue to benefit from the repricing of assets, which is really a timing issue with the Fed tightened so aggressively. The asset side of bank balance sheets is now finally having time to catch up, and we should see fairly good net interest income growth out of the regionals as they benefit from net interest margin expansion. On the loan growth side, it's still relatively soft, so that's a potential call option, we think, for better net interest income in 2025 as well.
All right, David, great to get some time with you. Hope we can get you back. Baird's David George there talking to us about the banks, big and not small, but big and medium. Later today, we're going to speak with the CFO of Wells Fargo. You don't want to miss that interview at 3 p.m. Eastern Time. This is Bloomberg. Quick check on futures. After that cooler inflation number came out this morning, we saw rates come back down and futures shoot up. S&P futures up 1.4%.
It's almost at 6,000 once again. Can you believe it, Matt?
Yeah, absolutely. And it's really the banks pushing us up, or financials adjacent. Lazard is up big today. We're seeing Wells Fargo up big, BlackRock up big, Bank of New York. We'll be back with more on the big banks, beats, and the equity gains we're looking to see at the open. Bullishness is back. Moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures gain more than 1% on the major averages. The Russell right now, futures there up 2.5%, as a lot of these companies don't make any profits and they really need to refinance. So rates have to come down for them to do well. You can hear and see the opening bells. Pitney Bowes at the New York Stock Exchange. I would have thought it's a much bigger company. It's actually only $1.3 billion market cap, but it has more than doubled over the past 5 years. You have health in tech on the NASDAQ. They just went public a couple of weeks ago at $4, and they're trading at $6, so that's a pretty good move. A check on the major averages in terms of what we're seeing in the live trade this morning. Going to look a lot like futures. Very good. S&P 500 right now. Is this the cash trade? Up 1.4% at 59.25. So to Sonali's point, just 75 points away from 6,000 now. Again, NASDAQ up more than 21,000, a gain of 1.5%, and the Russell 2000 up more than 2.5% at 2276. In terms of the stocks to watch, these are all of Sonali's favorites. JP Morgan knocked the cover off the ball with trading. Wells Fargo, Goldman Sachs, also big beats. Among the banks with higher earnings and revenue, the sector really topping Wall Street expectations. Trading desks capitalizing on election volatility last quarter. Net interest income growth looks solid for 2025. Remember, wasn't it just a couple of months ago when JP Morgan warned on net interest income. It's only going to be 87 billion. Now they're saying 94.
That's the game. You set the bar low, and then I think it's you knock the ball out of the park is the saying.
The cover off the ball.
Whatever. Anyways, also rising. Goldman more than 4% as the market opens. BlackRock another 5%. Interesting here. Goldman profit doubled in the fourth quarter. Traders just knocked it out of the park as well. BlackRock making the biggest gain since 2022. Rapid growth under private assets. Assets under management ballooned to 11.6 trillion. More on results later this hour. They added as much money as a small asset manager would have. Let's raise the board. Look at regional banks here and BNY Mellon because shares rising after profit and net interest income top expectations. Fourth quarter profit exceeded analyst expectations thanks to higher interest rates. Unchanged at the open, it looks like. This has been a darling of the financials in recent months, Matt.
Yeah, absolutely. And the futures were up big. There you can see it now up 4%. Sometimes it takes, 30 seconds, a minute, a little more for a stock to open up. And I think that was the case with BNY Mellon. A big bump along with the rest of the financials that we're watching. Joining us here at the desk is Alpine Saxon Woods Chief Market Strategist Sarah Hunt. Sarah, I got to ask you first about the CPI numbers coming in a little bit cooler, and that really changed the tone for this market.
It absolutely did. And this is where you're seeing that data by data point. Each one is going to make these big swings because when it looked like inflation was getting a little hotter and the Fed was getting a little more hawkish, all of a sudden you had a really tough December and you had a tough start to the year. And so I think that if we can see that progress or stay where it is as opposed to get worse, I think that's going to be good news for markets. And you can see that here, plus good earnings.
It's interesting. Good earnings. BlackRock shares are actually rising the most since November of 2022. KBW is the biggest in a month. Financials were part of that broadening trade, weren't they? Were you as optimistic as other parts of the market as you were about financials here? Do you think there's still underpriced opportunities to pick up into earnings season?
I think that the financials were one of those places where they got some enthusiasm on the idea that you'd get regulation, some relief there, but I think that the numbers had to come through. And I think that what we're seeing this morning is very good for equity markets because we're looking for some growth. Everyone's looking for earnings growth into next year. You have to figure out what sectors it's coming from. People have been relying heavily on technology. I think there are some areas, but the market as overall is not enormously inexpensive at the moment. So you do definitely need to see those earnings come through. And I think that today was good for that.
One of the other things that I didn't count on, and I think a lot of other market participants didn't really see coming, was rising energy prices. Brent crude is now back up over $80 a barrel, WTI rapidly approaching. As we enter, a new period of drill, baby, drill, why and what does it mean?
So I think that there are some things that are going on in the energy markets that are somewhat specific to a change in someone trying to enforce some of those sanctions that were very not enforced for a long time at the end of this administration. That's part of it. It's playing into some of the other issues that are going on in terms of transportation. But to be fair, there's quite a bit of oil production and demand is better than expected, but it's not so strong that this is a driver. There's some idiosyncratic things that are going on in the oil markets.
Yeah.
I'm not sure that we can expect oil to stay this high, and I think that there is more of a regulation relief expectation more than necessarily a bump in production that just means that there can be more steady things and less bottlenecks. I
saw a headline this morning that Europe is planning to phase out Russia's natural gas, and I was thinking, how insane that 2 years into this, Europe is still funding Moscow's war on Ukraine. It's just nuts.
I think it just shows you that no matter what you would like to do, the reality on the ground is you have to keep people warm. You have to keep the lights on. All of these things are connected very, very tightly. And unfortunately for Europe, they were quite tightly connected to Russia for a number of years. So turning that tap off and trying to find a substitute has been difficult. It's one of the reasons that we like natural gas. It's one of the reasons we like LNG plays here, because I think that there's going to be a continuous stream. And I also think that there's been a big shift where people are realizing that you're going to have an and on hydrocarbons and not an or. And that and is going to last, that tail's going to last a lot longer. I mean, we've been saying that, but those stocks haven't really been reflecting that. I think you're starting to see that much more this time.
Something that's been interesting to me in the trade this year, speaking of other sectors outside of technology, the energy sector has also been impacted by the technology sector. You see companies like Constellation, the promise of nuclear really drives some stocks meaningfully higher. And I wonder if you see a bubble forming in some of these AI adjacent stocks.
I would say, I wouldn't say that for the energy sector as a whole, because I certainly was reading some stuff. We're looking at a couple of different companies, but there's a lot more that they can do on cost now because of AI on the service sector to the oil business. On the utility side, it's hard to say what that is because these are assets that are difficult to replicate. So are all of a sudden we pricing it now on assets as opposed to earnings? That makes a difference. And I think that there is some concern about how fast some of those stocks have gone up relative to their earnings power, but it starts to be a fight for assets.
Jamie Dimon today said the two risks are inflation for 2025 are inflation and, a war, essentially, geopolitical risks. You say defense stocks are a sector that doesn't look expensive. Why haven't they been bought up?
Because the decisions or the discussions on government efficiency and the concerns about whether or not we're going to stop spending as much on defense because we've got other budgetary issues, I think has coalesced into the defense group just not acting that well. But I don't disagree that the global political situation is not calm at the moment. So I don't think that I think the defense stocks got rotated out of, and they look interesting to us here. And there's a lot of, we saw the hearings yesterday, right? So there's a lot of question about who's going to lead what and what that's going to do to current contracts and everything else. So I think that there's a lot of flux. And when there's flux, those stocks tend to be unloved for a variety of reasons. But you've got some decent yields there, and you've got some decent balance sheets there. So I think that there's some room there.
Speaking of decent yields, you're looking at a 10 basis point or more drop across the curve on the heels of that CPI data. Of course, that gives fuel to the equity markets. But I don't believe anything I see anymore. These markets have been so volatile, particularly the bond markets. How much more concern do you still have, even with a confident CPI print, about the direction of yield?
No, even with that drop, we're still at 466 on the 10-year.
Well, so this is the issue, because all of a sudden we started to creep back up to 5%, and people really started to get worried. And there's a psychological thing about 5% that's probably more than an actual thing about 5%, but it's whether or not, are we still in an easing cycle? Are we in a pausing cycle? Are we going to have to go back to a hiking cycle? I don't think we have to go back to a hiking. We don't think we have to go back to a hiking cycle. But you might pause for a lot longer than people thought. And that's tough, which is why, we're very much on capital return and balance sheets. So what do your balance sheets look like? What does your cash flow look like? That is something that is not going to be solved by an interest rate cycle coming down. You have to be good at this under any interest rate regime. And I think that's that's what got markets very rattled through December and the beginning of January. And some of these prints are giving a little bit of relief. But the relief is just kind of going back to where we were before we started to get really worried.
Sarah, we thank you so much for joining us here on set. Of course, huge start to earnings season. Looking forward to seeing how this one goes. That is Sarah Hunt of Alpine, Saxon Woods. She's the chief market strategist there. And now to high interest, because there are a lot of headlines around the world, Matt.
Yeah, the SEC is suing Elon Musk over his purchase of Twitter. The agency accuses the billionaire owner of not declaring his stock purchases in a timely fashion, depriving Twitter owners at the time of the real value of their shares. Musk's attorney didn't hold back in response, accusing the SEC of harassment and calling the charge a sham. And don't worry, it's only a week until those guys are out. Israel and Hamas are accusing one another of delaying a Gaza ceasefire that would involve exchanging hostages for prisoners and sending aid to the beleaguered Palestinian territory. Officials say an agreement for a 6-week pause in the fighting is still likely soon. However, past failures to get a deal finalized is leaving room for caution. And in the wake of the fires ravaging Los Angeles, real estate vultures are circling the middle-class community of Altadena and other burnt-out parts of the region. Those vulture investors are offering unsolicited and lowball offers for properties that were impacted by the wildfires. Yesterday, Gavin Newsom, the governor, issued an executive order banning these practices for 3 months.
And coming up, the U.S. plans to unveil new regulations to prevent chips from being sold to China. We're going to take a look at the final push by the Biden administration next. This is Bloomberg.
Let's get top calls right now. Some of the analyst action that we are watching this morning. First up, KB Home is no longer a sell at Seaport Global Securities. The home builder getting upgraded to neutral. It reported earnings and sales that topped estimates in the fourth quarter earlier this week. KB Home is also based in Los Angeles. The CEO, speaking on the analyst call, said it was too soon to calculate the impact of the fires on the company's business. Next up, Stifel says XPO is no longer a buy, downgrading the trucking and logistics company to a hold. The analyst says the downgrade reflects the stock's near peak valuation. And finally, Bernstein is upgrading EQT to a buy. The firm says the energy exploration and production company will benefit from significant power demand growth. Bernstein also says the new U.S. gas landscape will see significant but highly uncertain growth until 2030. Sonali?
And Matt, as we've mentioned, the Biden administration turning the heat up on China in its last week. It's planning new regulations to prevent advanced chips from being sold to China. The rules aim for more chip makers to more carefully scrutinize customers and increase due diligence on who they're selling to. Here with the latest, Bloomberg's Caroline Hyde. How do you take stock in these last set of moves, and what will be made of them in the next administration?
Key question, what happens in the next administration? Under this administration, they are moving thick and fast to be able to basically stop what happened in the past. Huawei, which is on the entities list, managed to get hold of TSMC chips, and were using them in the process for some of their most sophisticated chips they were making in-house. Now we start to see that wants to be curtailed. TSMC, for example, is going to be limited. It cannot sell anything more superior than sort of 14 to 16 nanometer chips. But also there's an interesting nuance. 30 billion transistors. Basically, these are the switches that are being pushed more and more onto these chips to make them more and more powerful. The more transistors, the more powerful they become. Now, 30 billion and above is basically okay. Now, and below, even in terms of the amount of transistors. That actually, according to Bloomberg Intelligence, isn't that bad. They're saying, look, maybe we'll see TSMC be able to hold on to about half of its sales of chips into China at the moment, because they're still going to be able to sell the less powerful chips that go into smartphones and PCs and the like. But it's AI accelerators. It's the development of generative AI that is the key concern for the U.S. administration here.
I'm sure we all recall the great New York Times piece on how even U.S. chip makers don't follow the rules and sneak chips into China.
Or don't look hard enough.
Sorry?
Or don't look hard enough.
Right. I mean, if we can't even regulate our own companies, is there any hope that we're going to be able to regulate Taiwanese companies?
Well, it seems as though thus far there've been a lot of focus on the Japanese, the Europeans, and basically all allies who sell sophisticated chip-making equipment, whether that be ASML with their chip-making equipment, whether it's the Japanese as well, or whether it's Taiwanese with Samsung and with TSMC. There is a hope that you can clamp this down. There is by trying to maybe give the odd inch here, by the fact that you can get on a list that says, we trust this particular partner. Maybe you allow TSMC to say, okay, this isn't as bad as it could have been, so I will oblige to the US administration. But as you say, look, NVIDIA, a homegrown chip maker, yes, of course, Jensen Huang himself is of Taiwanese descent, but he's currently fighting against the latest administration moves on his company because it's making it so complex as to where he can sell, what the level of...
Isn't he currently in China?
He is, yeah. Because it's a huge market for him. So they've got to be able to have this nuance. How much can they give to ensure they don't totally choke off future growth, but also limit the sophistication with which China can start to use generative AI products? Look, we're forcing China to make their own. This is what the outcome is, but it's going to take years for them to be able to compete against chip-making equipment like ASML and indeed chips made by TSMC.
And in the meantime, they do respond. They say that the rules are a flagrant violation here, and this all adds to the rhetoric.
Yes.
Who says that? China, you mean?
Yes.
Of course
exactly.
they say that.
Well, but you add that on top of a lot of the latest news this week alone. In terms, you think about TikTok. ByteDance, that's a different situation, of course, but the rhetoric is getting more intense.
Yes, and the tit for tat continues. Remember, when we're looking at EVs, well, China has that whole battery market sewn up, and they're going to be starting to limit the amount that we can access their own EV batteries. Remember, that's crucial for the likes of Tesla with CATL.
There's no tit, there's only tat, right? Because none of our social media apps are used in China, and we're so addicted to their social media apps that our president, incoming, is fighting for the ability of a Chinese company to run it. You know, they don't use any of our battery technology. Our major car makers are using their battery technology in Detroit.
This is just another reminder that the next time we have you on, we need to talk about Meta.
Yeah.
is the final word on that, I think, Matt.
Yeah, you're not using Instagram in China.
Globalization worked when it worked, and countries were good at the best things that they were good at making, but now it unravels.
All right, Caroline, it is So much fun having you on.
Always,
Carolyn Hyde
thank
is
you.
going to go off and get ready for her show. She anchors Bloomberg Technology that kicks off at 11 a.m. We are going to go back to the financials. We're going to talk about BlackRock. It saw record inflows of client cash in 2024 as it sold, I think, 400 billion worth of ETFs, and it has a fast-growing private market arm becoming more and more lucrative, that business. It's next in our Wall Street Beat. This is Bloomberg. This is Bloomberg Open Interest. Get a quick check on how stocks are trading just about 22 minutes into the session. Right now, the S&P 500 is up 1 2/3% at 59.41, so getting ever closer back to that 6,000 mark. The Nasdaq currently up about 2%, and the Russell 2000 up 2.3%. So after inflation came in the form of CPI cooler than expected, rates came down and stocks went up.
They are ripping, and we are closer and closer to that 6,000 level. As you know, I've been waiting to get there all year. But I'm going to look now at BlackRock. The financials are rising, so too is BlackRock, up almost 6%. Assets under management came just shy of estimates at $11.6 trillion. But it received a record $641 billion in client cash in 2024, $390 billion of that going into its ETF business, and $226 billion into equity funds. All of that together is larger than the size of KKR's asset base and many other smaller asset managers. Just incredible. Bloomberg intelligence analyst Neil Sipes has more of the details. One thing that strikes me here about BlackRock is the look forward. You have Larry Fink talking about this being just the beginning, and this year the firm adding more in terms of capabilities in private markets. Controversial question is, are they doing this at a time where fees are compressing in the industry? Because anecdotally, we're hearing that even private markets are looking to give discounts.
Yeah, look, and I think that's something that's pervasive across the space. We know that specifically with BlackRock's legacy platform, the BGI iShares products that they have now. That's been a huge driver of fee compression across the industry, the rise of index funds, ETFs. That's going to have weight across active mutual funds. We've seen that over the past 2 decades. That eventually may trickle into private markets. Again, private markets were starting from a much higher base on those fees. And ultimately, the return opportunities, the uncorrelated potential for those types of products are going to continue to justify those fees longer term in our view.
Well, private markets are going to trickle into ETFs, right? That is the growth that astounds me. 400 billion in ETFs. How much is that set to continue?
Yeah, I think we do expect it to continue. You probably talked to Erik Balchunas on the ETF team here. That's a market that's expected to grow, to 35 trillion.
At the same level, though, right? So this year they could bring in another 400, 500, 600 billion in ETFs alone.
Correct, and that's all really investor demand. And when you sort of look at the go forward over the next 5 years, that's where the growth is expected to be, those passive ETF products. But on the other side...
Or active ETFs.
Correct, and that's still a very small piece of the pie there, but that's one that's growing incredibly quick as well. And by the way, those fees are obviously more attractive than a passive type ETF. But on the other side of those ETFs is going to be that private market space. That's where BlackRock is sort of positioning themselves. We talk about that barbell strategy in asset management, passive on one side, alternatives on the other.
Just really quickly, 30 seconds here. Do you think that the future of BlackRock is in the hands of somebody else, really? Because you saw a major executive, Mark Wiedman, leaving the firm. You think about Rob Goldstein, for example, and all the efforts he's made in Aladdin and technology. Is there more growth to be squeezed out of BlackRock as kind of like an everything store, like a bigger technology player?
Yeah, I think that is true. And I think, when we think about BlackRock, it has its hand in all sorts of different categories across the investment management space. So the question for BlackRock has always been, once you're at 11.6 trillion, how do you keep growing? Well, this quarter, they really showed us. That's why you see the strong performance today. that scale is not an inhibitor for growth for them, and we'll look for that going forward.
Neil, we thank you so much for breaking this all down for us. Bloomberg's Neil Sipes. And of course, Goldman headlines still coming out right now. The call's still going on, even in a record quarter. I think this is fascinating. They're pushing back on those stress test transparency measures. We talked about that with Erik and Diane. They're talking about expense discipline with vendors. So even if Goldman is paying their employees more, they're telling the people they work with, like, don't expect us to be shelling out all that much this year.
Yeah, the stress test issue I think is really interesting for sure. Coming up in the next hour, we have Faber on. He's going to talk markets with us. Diane Swonk on inflation. Erik, Hirsch on private markets, and Stephen Diamond on deals at the JPM Healthcare Conference. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today. Coming up, a slowdown in consumer prices that bolsters bets that the Fed will still be able to cut interest rates this year. And earnings season kicks into full gear. JP Morgan, Goldman, Citi, and Wells Fargo all reporting robust results. Plus, BlackRock pulled in a record $641 billion in client cash last year, with Larry Fink saying that it's just the beginning.
All right, let's get a check on where the markets are trading after that inflation number came in cooler than expected. Rates head down and stocks head up. S&P 500 gaining 1.7% right now at 59.41, 59.42. NASDAQ up at 21,176 right now, a gain of 419 points or 2% even. And U.S. 10-year yield, although it's down 14 basis points, still at 465. So I would say still, I guess, depending on where and who you are, still pretty restrictive.
Better than 480, though. We will take it for today. Also taking a look at the big banks that reported results today. They like those higher interest rates. JP Morgan, Citigroup, Wells Fargo, Goldman Sachs. JP Morgan, Wells Fargo saying net interest income will be higher this year. You're seeing Goldman shares just ripping right now, up 6%. Wells Fargo pretty close, up almost 6%. JP Morgan actually pairing some of those gains, but still up almost 1%. Citigroup up more than 6%. They're going to buy back $20 billion worth of stock. A lot of good news to go around, Matt.
Yeah, there is a lot of good news, and it's not just the money center banks, as we were talking about earlier. You've got some of the boutiques doing really well today. Lazard was one that I was looking at, that we were looking at before the market. It's actually only up 4% right now, but in the pre-market, it was up 9%.
Moelis, PJT also rising. Fun fact, Evercore on an annual basis brings in more advisory fees than even Bank of America. So a lot of business moving to the boutiques. Bankers get paid in a lot of stock, so they're pretty happy today. What I would imagine.
No, absolutely. Joining us now to talk more about this is Faber, CEO and Chief Investment Officer of Cambria Investment Management. And before we get into any strategy or ETFs, I just want to get your take on the inflation and Fed situation here. There were worries that the Fed might even have to raise rates as inflation seemed to be headed back up. Now I know it's only one data point, but CPI softer than expected. What's your reaction?
We like to use the 2 years as a good proxy for where Fed funds should be, and usually they rejoin at some point, right? They can zig and zag and have some separation. The biggest curiosity in all of this fixed income land, though, is not necessarily the Fed funds rate. It's where T-bills are relative to everything else. So you guys were talking about the 10-year. And in a normal spread versus T-bills, 10-year should be up north of 5.5, almost approaching 6. Now, people hear that, they say, oh my God, that's crazy. But that's been the historical relationship for the past 100 years. And if you look at investing in a lot of these risky fixed income markets for a stock guy like me, makes no sense. If you look at corporate bonds, you look at junk bonds, you look at the 30-year, all these types of riskier fixed income markets. We wrote a paper on this last year called T-bills and chill. They don't pay you enough yield. And a lot of the corporate and junk are at some of the lowest spreads ever. Historically, that is a horrible time to invest in riskier bonds. We have a fund that does this called TYLD, and right now it's signaling you should be 100% in T-bills. So people see these higher yields just because they're used to so many years of zero, and they say, oh my God, I can get north of 4 on the 10-year and corporate bonds, but really, you're not getting anything relative to T-bills. And I think despite all the losses we've had in bonds, there's the potential that that entire curve could move higher, which means potentially more pain for fixed income investors.
You know, Meb, I really am curious about this dynamic in fixed income because even on a day where you are seeing the 10-year compressed, you're seeing yields much lower than you did just a couple of days ago. At the same time, you have a lot of investors worried about the U.S. fiscal situation. I mean, how much risk is there still in the bond market right now?
We wrote another paper called "What is the safest investment asset?" And if you ask people like I do on Twitter, you say, how much has T-bills or bonds declined on a real basis after inflation? Most people say like 0 to 10% or something, and the answer is over half, right? And so these are not risk-free type of investments. And so I think a lot of people learned that again in 2022, but the safest investment, oddly enough, Michael Saylor and I have the same theory when you go down this. He takes a hard left and I take a right, but it's actually a diversified portfolio. Now that sounds a little cheesy, right? But when you put all these assets together on a real basis after inflation, whether it's worst year, worst month, lowest volatility, on, you can make the argument that a diversified portfolio is much safer than T-bills because for many investors over time, the biggest enemy is not these little jiggles, it's inflation, right? And this eroding impact. And so for fixed income in particular, that can be really punitive over long periods where you have these periods where you end up in these giant drawdowns. So not a risk-free investment, but relative to everything else, T-bills look better.
I mean, it's a great point, Meb, and even for stocks, right? I always think about the return I can get when I'm looking at bonds, but also when I'm looking at stocks, dividends, and buybacks. And you have a different take on this in terms of your unmarketable, most unmarketable investment thesis.
We got a lot of contrarian takes, but look, everyone's fat and happy in stocks right now, man. We've had one of the best periods in history for the U.S. stock market. It's done 15% per year since 2009. That is extraordinary. That's been a 10-bagger, right? We've had some of the highest sentiment. If you look at Investors Intelligence Bulls Bears, it's one of the highest ever this past year. So it's all rainbows as far as the eye can see. Now, of course, what does that lead to? High valuations, on and on. But so everyone right now, so I shouldn't say everyone, a lot of people are sitting on big gains, right? And if you're a taxable state like I am out here in California, theoretically, and no one is going to agree with this, so I want to qualify this ahead of time, you don't want to pay taxes, right? People try to minimize taxes, and theoretically, an equity investor shouldn't want dividends. Now, there's behavioral and psychological reasons you want dividends, but if you can match the returns of the stock market and not pay dividends, mathematically, you're going to be in a better place after tax. We actually just launched a fund to do this. It's called Tax, to pay low to zero dividends over time. And so for many investors, they hear that. They're like, oh my gosh, that sounds like the worst strategy. Buffett gets it. Berkshire, as a stock, hasn't paid a dividend in I don't know how many decades, 6? And so it's a strategy once you start to think about it, particularly high dividend or REIT style strategies in a taxable account. The difference between one that pays a dividend and one that doesn't, if you can match the return, can be multiple percentage points of after-tax returns. But most people only think about taxes come April, come into the year. But really, you need to think about it ahead of time, too.
Well, you know, what is the saying? The only thing in life that's sure is death and taxes, Matt? Is that how it goes?
Yeah, unfortunately.
You know,
and I'm not worried about death.
I am worried about taxes. You know, Meb, the reason we're worried about taxes is because we don't know what they're going to exactly look like in the next administration based on what happens in Congress. And to the extent you're calling up your congressman and saying, this is what I need to see in the bill, what is it?
Well, I want to make a quick point about ETFs and taxes, because again, a lot of people, there are trillions of dollars stuck in these historical asset strategy structures that are just not optimal. So the mutual fund versus ETF, Bank of America said the other day, that structural decision alone for an equity investor is 1.2% per year. So that's fees and taxes combined. And you know, we come in here all day, talk about what's gold going to do, what's the Fed going to do. That's over a percentage point just choosing an ETF over a mutual fund. So a lot of these decisions about taxes can really matter. We said on Twitter, the most impactful story in all of our world last year in the ETFs is not the crypto ETFs. And that was a massive story. It's actually this new developing concept of the 351 ETF exchange, which is a mouthful. but actually it's like 1031 for stocks. So starting to think about how people can move these concentrated positions, these gains into portfolios in a tax-efficient manner, I think you're going to see a revolution in the next 5 years, tax location, tax optimization for investors, instead of just, hey, I'm going to buy this portfolio, patchwork, deal with it later, which ends up being pretty suboptimal.
Meb, great to have you on the program. Thanks so much for joining us. Meb Faber there of Cambria Investment Management talking to us about investment strategies and taxes. Let's get a look at stocks moving at this hour. For that, we go to Bloomberg's Jess Menton. She's with us here at the desk. And Jess, I want to kick off on quantum stocks. Some of them we've been watching pretty closely over the past few days.
They have, and they've been on a bit of a tear of late, just given the investor day that we did see from NVIDIA earlier this month. So if you look at what's happening with quantum computing, so that stock's up almost 40% right now, on pace for its best day since December 18th. So that would have actually been Fed Day, and when we did have kind of a broader sell-off on the market. So you are seeing that up, and actually just to point out, that stock's actually up over 1,000% in the past 12 months. So a lot of this has been supported if you're looking at what's happening with Microsoft. So they did declare that 2025 was the year to become quantum ready. So they unveiled a corporate training program, and this does come on the heels after NVIDIA's CEO Jensen Huang said that quantum computing is 20 years away here. So you are seeing the support here in that corner of the market.
You know,
20 years seems like so long.
2 decades away.
He's talking his own book to some extent.
It happens faster. It happens faster than you think. You know, I want to go to another sector here as well. We're watching technology. We were also watching consumer this week. You may remember there were a bunch of results out.
That's right.
Lululemon was promising, but they're giving up some of their gains.
So actually, if you're looking at Lululemon, down about 0.3% here. That stock's actually down almost 20% if you look over the past 12 months. So a lot of people sometimes think of the more expensive type of kind of athleisure wear. But we did see in recent quarters where people were still willing to do that. But actually, they did raise their Q4 sales, gross margin, and inventory EPS guidance. So you actually are seeing some price targets getting raised, even though the stock's not doing a lot right now. So Morgan Stanley was actually one of them. So they raised it to 420 from 414. So they do see some optimism there that they're looking up when it comes to those EPS estimates. And then Wells Fargo is actually another firm that raised those outlooks as well. So it has an equal weight and actually ranges with a price target from actually had been 350 to 375. So when you think about the retail segment of the S&P 500, not the best outlook when it comes to those earnings growth estimates for the fourth quarter. Obviously, the holiday spending quarter. So it's going to be interesting as we see more of these retailers come out here.
So Lululemon down 420 and the price target up to 420. Jess, thanks very much. Jess Menton there talking to us about some of the stocks we're watching. Coming up, U.S. consumer prices rising less than expected last month. We'll discuss the latest report with KPMG chief economist Diane Swonk next. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. Germany's economy contracted for a second straight year. The data is coming in ahead of a general election next month. The outlook for growth looks dim, with no end in sight to the country's manufacturing malaise. The head of Germany's IFO Institute called the current period of Germany's longest phase of stagnation in post-war history. BlackRock CEO Larry Fink says it could take a decade to rebuild Los Angeles after wildfires ravaged the region. Fink believes the government will need to address homeowners insurance over the next 4 years while consumers reckon with the destruction. He added that firms may need to redefine event risk in different parts of the country. The fires have resulted in estimated insurance losses of as much as $40 billion and have killed dozens of people. Bloomberg has learned that the U.S. plans to ban the artificial food coloring red dye number 3. The chemical has been linked to cancer and is currently in a host of products, from candy to cold medicines. The move comes 30 years after the artificial food coloring was banned from use in cosmetics. Robert F. Kennedy Jr., President-elect Donald Trump's pick for health secretary, has long been a proponent of that dye. Sonali?
And we've been looking all morning at the December CPI report because U.S. consumer prices rose less than expected. Core inflation came in at 0.2%, but headline inflation accelerated to 0.4%. We're going to talk about it now with KPMG chief economist Diane Swonk. Does headline inflation bother you? I mean, a lot of the market was so calmed by that core inflation coming down, but there are still some volatile elements of overall inflation.
Exactly. Well, we saw the big pickup in prices at the gas pump, which came on the heels of not only a record holiday travel season during the December 21st to January 1st period, which AAA alone estimated some 107 million Americans drove more than 50 miles. But we also had in the employment report for the month of December, a record December, going back to 1976 when they do it, of people mid-month on vacation. And so that helped to buoy some of those prices. We also saw prices at the grocery store remain sticky, and those egg prices continuing to go up on the heels of the bird flu. That's the largest single protein for low-income households, and those have gotten extremely expensive. They're up about 36.5% from a year ago, but this is on years of bird flu and the culling of the chicken stocks, which has had a residual effect on food prices. When you get into the data, there was some good news and some less good news. We saw the shelter costs remain buoyed by rents, although homeowners' equivalent rent actually fell or slowed down a bit. The biggest increase out there, though, I think is really important, was the surge in vehicle prices. New vehicle prices and used vehicle prices picked up during the month, and that reflects not only the replacement demand related to earlier hurricanes, but also we've seen, and we don't know if this is true yet, that consumers in the Consumer Sentiment Index in December and January said that they're buying ahead of what they fear to be price hikes related to tariffs in record numbers. We did have the highest vehicle sales in December since May 2021 before we ran out of chips and could not satisfy consumer demand.
By the way, we'll get to tariffs, Diane, although it's obviously at this point it's a lot of speculation. In terms of I was just talking about Larry Fink's predictions for how long it's going to take to rebuild L.A. In terms of natural disasters that we've seen, a huge pickup in them, wind, flooding, fire. Is that going to drive inflation higher over the next, over the coming decades?
I think it is, and that's something we've seen. You can look at the charts. The number of billion-dollar up disasters has been rising fairly rapidly, and whatever your views on climate change, the fact is it's happening, and it's showing up in everything from insurance prices to the cost to rebuild and repair, and a blow to wealth. This will be an enormous blow to wealth. We saw a blow to wealth from Helene and Milton in September and October that showed up in the wealth data as a blow to wealth because of the sheer number of homes that were wiped out. I think these are very important things to remember, that oftentimes the trigger in economic activity is that it causes and stresses existing resources to repair and rebuild, even as the emotional and the economic devastation and threat to livelihoods is elevated. And that is a hard sort of reality we live in, but it really does. In a world where inflation and the battle on inflation has not yet been won, we are much more prone and susceptible to these kinds of disruptions. Even more importantly, what we've seen is supply chains are elongated now, ironically, in an effort to get away from existing tariffs and make them more resilient against geopolitical risks. That makes them more fragile.
If Matt were to ask this question, he would talk about the speculation, of course. I think I'm trying to look at him and read his mind on exactly what he would say. He would talk about.
Well, it is speculation, but I think.
But they're a reality no matter what. And that's the thing, Diane, whether you're thinking about the tariffs or the immigration policy, let alone deportations, what are the ultimate impacts that you're preparing clients for at this rate?
So we've looked at three scenarios, looking at different packages of more targeted tariffs, just a trade war with China with some targeted tariffs, then more escalated, full-blown trade war, depending on where the new administration comes. Now, remember, they're relying on tariffs to pay for some of the tax cuts, although tariffs technically, through executive order, should not be considered in reconciliation, although we think they'll be ruled in anyways, because they could be obviously revoked at any point in time. And it's important to understand that there's going to be some kind of tariffs out there. The escalation in tariffs, what we worry about this time is the rest of the world is more prepared, and particularly China, and they're looking to specifically disrupt those more fragile supply chains. So that is an inflationary consequence. The tariffs are a regressive tax. They hit lower and middle income households harder than high income households because they're like a sales tax on everything. And so that's important as well to remember. We have seen a lot of wealth effects out there that we have 40% of what the S&P, their earnings actually are dependent on growth abroad and what's going on abroad. So you can see where if we get into the worst case scenarios where a full-blown trade war, along with curbs on immigration, which was a major part of the soft landing scenario by the Federal Reserve because immigrants filled vacancies that many native-born would not, as job openings soared. All of that does make for a more difficult situation, especially given how much farmers have already asked for a waiver on immigration. Agriculture, leisure and hospitality, and construction, California.
Yeah. I mean, I think the labor costs.
Those areas depend most on it.
I think the labor cost situation is going to be fascinating, if bad. Diane, thanks so much for joining us. Diane Swonk there from KPMG. Still ahead, tobacco stocks getting the opposite of lit as the FDA weighs a new rule to cut nicotine levels. This is Bloomberg.
It's time now for Social Climbers. The company's making waves this morning. And first up, Texas is suing Allstate for allegedly collecting driver data without consent from 45 million customers and then using that data to justify charging more for car insurance or denying coverage altogether. An Allstate representative said that its software helps consumers get the most accurate auto insurance and that customers have consented in a transparent way that complies with all laws. And Starbucks says that it will give catastrophe pay to workers affected by fires raging in Los Angeles. The coffee giant didn't say for how long baristas can claim catastrophe pay. The company also offered emergency compensation during COVID-19 workers affected by the virus. And finally, the FDA is pushing ahead with its plan to slash nicotine levels in cigarettes. The incoming Trump administration will decide if the proposal moves forward. And the effort to curb nicotine comes after the Biden administration delayed its attempt to ban menthol cigarettes in flavored cigars. The FDA was slated to finalize the ban last year, but halted plans because of an immense amount of feedback, Matt.
Do you watch Landman?
I don't. I want to.
They smoke a ton of cigarettes in that show. It's like from the 70s. Quick check on the markets here. You can see the S&P 500 up almost 2%, more than 100 points to 59.43 after inflation came in light. Coming up, we're going to talk to Hamilton Lane about private assets. This is Bloomberg.
Hamilton Lane is looking at the retail business. The firm, known for its private market investments, is looking to bring investments to retail investors in a bigger way. In a relationship with Republic, together they will also be launching a digital blockchain-based solution for individuals. Here to explain the vision, Erik Hirsch, Hamilton Lane co-CEO. Erik, you know, this retailization of the private asset industry is perhaps the biggest trend going on. You see it from BlackRock to Apollo. And yourselves, how do you think that this will evolve this year? What's the biggest move being made?
I think this is a beginning of what's going to be a long journey. I mean, the individual investor has been essentially kept out of an asset class that the institutional investor has had the advantage of for the last 40, 50 years. And it's been a huge advantage. If you take a look at any pension fund that's sort of done reasonably well, private markets have been a huge driver and contributor of return and performance for them. And so I think the individual investor has seen that. They've gotten much more educated on it, and they simply want what the others have had, frankly, for a while.
You know, another interesting aspect of this, too, is tokenization. I'm wondering how much that will really help bring more retail access to these private funds. I've heard over and over that bringing private funds into tokenized form to investors could help really reduce a lot of costs when it comes to paperwork and middlemen and otherwise.
I absolutely believe that to be the case. Again, our asset class was completely designed for a large hugely sophisticated institutional investor that frankly liked a lot of that bureaucracy because it was sort of a check and balance system. So tons of paperwork, very laborious, very manual, lots and lots of lawyers involved. And I think what you're sort of seeing is that there really doesn't need to have that exist anymore. Technology has advanced to a point where we can do these things successfully, safely, securely on blockchain. And so I think this is no different than what we have seen the trend for all of us individually of we want things sort of better, faster, and cheaper, whether that's ordering dinner or whether that's getting a refill on grocery items. This is really going to be the same. So I think the token part of it is simply allowing access to be there. And you're right, Sonali, significant reduction in both the friction cost and the actual cost. And this is simply a move closer to being able to do all things that we do now on our smart device.
Yeah, I'm a convert as well. But it's really just about back office, not much else. Except for it does bring costs down, right? Make things faster, gets us closer to T-0. Erik, I wonder more about the private market side of this. Do private markets offer investors a benefit beyond, or the companies a benefit beyond kind of regulation light? Is that the main point?
I don't think this should be regulation light, frankly. And I think as we make this move more into that retail investor, this is going to go from today, regulation, I would say, sort of moderate to, frankly, a little bit heavier on the regulation side. And I think that's just fine. I think if we're going to sort of be a big person asset class, then we're going to have to hold ourselves to big person standards. And I think that there's nothing wrong with that. And if people are talking about kind of the ultimate dream of inclusion in things like 401ks, then we should just all go into that eyes wide open and expect and understand that the regulatory piece of this is going to rise and not fall. So that said, I think there are a couple of huge advantages. One of it is simply a diversification issue. You all have talked about it. We've all talked about it. The public markets have a concentration problem, and I don't see that problem going away. Companies don't want to be public. We're not seeing kind of a huge growth in the actual number of publicly traded businesses in the United States or elsewhere. And beyond that, again, we've never seen concentration at a market cap level among such a small number of companies as we're seeing today. That is a problem if we're saying to individual investors, hey, do the right thing, save for retirement, diversify, make sure that you've got your exposures correct. We're basically funneling them today into a system that is the opposite of that. Yes, the public markets can be accessed easily and cheaply, but they are hugely concentrated, and that is not great for our savers.
It's interesting because we are obviously days away from inauguration, and you and I have talked about this before, Matt, this idea of a new Department of Labor, meaning, okay, a look at what it would mean for 401ks and other assets to be making it easy for people to access private assets. Erik, 401ks, you brought it up again. I know the last time we talked about how this was a long road. But then you think about some of the existing players, it's hard to imagine a world where even BlackRock's not going to be fighting for that to happen now that they have more access to private assets. Do you think that this happens faster?
I think it's a question of what it is. I think if we're talking about taking traditional private market funds as they're constructed today and dumping them into 401ks, I don't see that. I think the whole tradability of 401ks and the ability for people to kind of rebalance real time means that you're going to have some real changes around how we value assets and the frequency that we do that. Sonali, as you well know, this asset class has existed for decades on a quarter marked with a lag. None of that's going to work in a 401k environment. So are there solutions to it? There are. Are some of them going to need to involve some regulation and rule changes? I think they will. And so I don't know that I see this as a tomorrow issue. I think there are steps that you can make that are going to be interim. So, for example, having a portion of target date funds have an exclusion around sort of real-time valuation, that would be a step forward, and that would sort of be starting a chance for you to kind of bridge your way into that 401k market.
I want to let you do a little marketing and also learn a little bit about your business, Erik. Why did you choose Republic as a partner on this? What do they do to make your product better?
I think this is really just about ease of access. I think for us, We see a number of players, Republic being a great example of that is building technology in a platform that's allowing individual investors to simply access the private markets through their system. And so for us, our big theme has been ease of access is absolutely critical. And secondary to that, making sure that those friction costs and actual costs are coming down. So we've partnered with Republic to do that. You've also seen us have other initiatives with firms like Securitize and others outside of the US, where we've been tokenizing a variety of our products and trying to put them in a multitude of platforms so that investors can find them. This is about kind of meeting the investor where they are. The individual investor, as we know from every other way that they transact, you need to meet them where they are. They're not going to kind of conform to what you want. Investors want it their way. So again, whether that's ordering food, dining, clothing, whatever, this is going to be absolutely no different than that. So I think it's going to be a question about access in a variety of platforms, ease of use, ease of use, ease of use.
Erik, we thank you so much for your time today. That is Erik Hirsch of Hamilton Lane. Certainly technology and transaction costs, just like every industry, the asset management industry is certainly where people are keeping a close eye on all that.
Yeah, no, absolutely. Really important stuff for investors. Coming up, biotech M&A is on the road to recovery. We're going to discuss the outlook after some big deals this week with Stephen Diamond. He's the founder and CEO of SPD Advisors. He comes to us from the JP Morgan Healthcare Conference in San Francisco. This is Bloomberg. Biotech deals off to a strong start in the new year. On Monday, Johnson & Johnson agreed to acquire Intra-Cellular Therapies for about $14.6 billion. That's the largest deal to be announced in more than a year. Joining us now for more on the outlook in biotech is Stephen Diamond. He's the founder and CEO of SPD Advisors. Stephen, you've been attending the JP Morgan Healthcare Conference. You're out in San Francisco right now. Tell me first about just the sort of animal spirits post J&J deal and, ahead of the Trump 2.0 administration. Are we going to see more and more big deals like this?
I think there's a good possibility of that, Matt. Glad to be on here. I think there are three themes coming out of JP Morgan. The first is that there's a big patent cliff. There's about $400 billion of patent expirations that are going to come. They're going to come in over the next 8 years, and that those revenues that are going to fall off are going to need to be replaced. I think a second big theme is that big pharma will continue to pay for high quality assets, and we're at a stage now where you've had a really rough 3 years in biotech. VCs may be more inclined now to take early money off the table and get a quick win rather than wait for an IPO and bigger gains. And the third one is that I think there's going to be a continued focus on taking costs out of the system and finding cheaper therapies to treat some of the diseases. There's just going to be a big rotation of insureds from the private healthcare market over into government care. And with the deficit and the debt, I just see a lot of pressure on taking costs out of the system.
Stephen, let's focus in on the first one of those. We tend to throw around a lot of big numbers and they become meaningless. So you say $400 billion patent cliff, and I don't really understand it until you add the context that the last time we had a big patent cliff was 2011, and it was $250 billion. What are the drugs going off patent, the big ones that we know about, and what do you mean by we need M&A to replace those revenues?
Sure. So let's talk. Take three for example. Merck's Keytruda. You've got Eliquis, which is a Pfizer and BMS combo, and then Opdivo. Those are 28 billion, 12 billion, and 12 billion for Opdivo in annual revenues. That's over $50 billion. Those are coming off patent in the next few years. So you don't just replace those revenues with internal R&D. It really to replace revenues like that at scale, you need M&A. And those are just three of many drugs that are coming off patent that are blockbuster drugs, and blockbuster being more than $1 billion in sales.
M&A is one thing, but then on the other side of M&A are the companies that are selling. And biotech, we talk to a lot of investors. It's kind of like the Wild West here to see what will be successful at the end of the day. How do you think through the next generation of rising companies that are going to be the ones that are the acquisition targets of tomorrow or the next big stocks?
So, a couple things. So if you look at the three deals that were announced that Matt was referencing, you had the $14.6 billion J&J deal for Intra-Cellular. You had Lilly's up to $2.5 billion deal for Scorpion, and then you had GSK's deal for IDRX, about $1 billion plus another $150 million in milestones. If you take those last two, both of those were deals that really strengthened and added value. They were high quality assets that added strength to existing franchise of Lilly of breast cancer. STX 478, Scorpion's lead therapy, really fits in nicely and tucks in with Lilly's breast cancer portfolio and allows them to pursue combination opportunities. IDRX, that deal had strong phase 1B data. That'll go straight to pivotal. And so, both of those are competitive processes run by Centerview. And what you are seeing is that Big Pharma will pay up and move quickly for high quality assets. On the J&J deal, they had Intracellular Therapies had a patent challenge from Sandoz that got removed and taken off the table. And so there you see Big Pharma moving quickly when an asset is de-risked.
Matt must say also.
Yeah. Sorry.
No, it's funny that you mentioned Centerview. We were watching the investment banks this morning. Centerview is really the kingmaker here when you think of biotechnology deals, and they're already showing some love in that industry.
Yeah, definitely an interesting angle. I wonder, Stephen, when you look at the incoming administration, and Sonali and I have been talking about, whether they're going to go the other way of Biden, but obviously they have populist drivers as well. The price of these drugs comparative to what other countries are paying, to me, is always just mind-boggling. If I want to get, Wegovy or one of these GLP-1 drugs, and I live in the UK or I live in Denmark, I'm going to pay like $150 a month. If I want to get them here, I'm going to pay $1,000 a month. And this isn't just Novo Nordisk, right? The U.S. drug makers, Eli, Lilly, and Pfizer, are also charging Americans exponentially more than they charge other developed countries. Do you expect the Trump administration to take that on, or are they just going to allow these big drug makers to have, the U.S. customers as kind of a lucrative ATM?
So, a couple themes there. One, you're right, there is a popular sentiment. J.D. Vance has been very outspoken on his support for Lina Khan, as the outgoing FTC head. On the other side, on drug, to address your point on drug prices, look, I think there's going to be a lot of pressure on PBMs, and there's a lot of inflation of costs that can be taken out of the system if you can reform that aspect of it. And payers, drug companies, patients, they all want to see prescribers. They all want to see some action there. And I do think that you will see, and Trump has been outspoken on this as well about the PBMs. I would anticipate some action against the PBMs from the incoming administration, to address the point.
Yeah.
But I do want to make one point.
Mm-hmm.
This is, this innovation has a cost, and you do see the cost of these drugs, but you don't see the cost of all the many drugs that failed, that didn't get to market. And, at some point, if we want to continue leading the world in innovation, that has to be funded one way or another.
Totally agree. But I just wonder why we have to foot the bill every time, How come in Germany I'm paying 10% for a drug that's made in America or made by an American company that I'm paying as a U.S. citizen? Why do I have to foot the bill every time? And I think especially the companies that are traded here, that we grow, we have to ask them to answer that question. Maybe it's the PBMs, maybe it's the middlemen.
Right. Stephen,
you're wrapping me up there,
Yeah,
huh?
I am wrapping you up.
She's wrapping me up.
Stephen, we do have to leave it there. That's Stephen Diamond of SPD Advisors. A lot of food for thought. Come back to us soon. The cost of drugs will absolutely be a huge topic in America. Maybe less in Germany, it sounds like, but very much in America. We're going to talk about other places a lot of money is being made, the big banks. We're going to talk more about that beat because you're watching those stocks still on a tear. More on the latest on earnings next. This is Bloomberg. Big bank earnings topping estimates this morning with Citigroup, Goldman Sachs, JP Morgan, and Wells Fargo helping propel equities higher. Joining us now, Bloomberg finance reporter Todd Gillespie. You're looking at some of those gains being given up at JP Morgan. They were the most expensive here. Citigroup getting a huge boost. This is interesting to me. $20 billion buyback plan. Appeasing investors even while lowering their return targets.
Right, yeah. Citigroup, they giveth and they taketh away. Jane Fraser has a big 2026 target that she's stamped on her forehead, and she's just, rolled that back after 2.5 years, more than 2.5 years, putting that front and center of her plan. She's rolled that back 1%. One might say not too big, but it was a really cool part of her credibility that's at stake here. At the same time, she's also sweetened the deal for investors, right? By saying that she's now going to buy back $20 billion worth of stock, and obviously investors love that.
I mean, I look over the last 5 years, right, and a stock like JP Morgan has doubled. Citi is still down, right, under zero. So she's got to do something.
Sure. Well, yeah, versus 5 years ago, the stock is still not doing great. But right now, today, that I think they're the top performer of the big banks today.
True. The last hour and a half, they've done really well.
Sure.
But if you're a longer-term investor than that.
Yeah. Well, I mean, one thing that you might say is, right, that analysts weren't expecting them to do very well anyway. Analysts have not been expecting them to hit these 2026 targets. They've called them, over-optimistic already. So maybe this is Citi, coming back down to earth a little bit, but also reiterating that, look, they understand what the path forward is now, taking stock and saying, look, hey, we understand maybe we were a little bit too excited, but we can still do this.
I think something that interested me a lot in these earnings, I love to get under the hood, because I do believe, Matt, that these banks will tell you a lot about the health of the markets. JP Morgan missed on equities trading. Their value at risk.
Wasn't it still up 22%?
But what's interesting to me is they took on more risk in the equities desk while underperforming expectations. And at Goldman, part of the reason they're rising so fast is because of financing. That sets the bar really high tomorrow, doesn't it, for Bank of America and Morgan Stanley?
For sure, yeah. I mean, these trading businesses in particular, we all said already that these were going to do very well. Analysts thought they were going to do very well. We had guidance that they were going to do very well.
And they did do very well. If you're up 22% in a quarter.
Right. Yeah. They did very, very, very well. And I mean, similar for Citi's equity and FIC businesses too. So yeah, you're right, Sonali. This bar is going to be set very, very high for the rest of the street. Maybe notably, we want to see investment banking revenue start coming back as well, right? This still seems to be a little bit gradual on that side. Everyone's leaning on this volatility around the election cycle for Q4, seeing trading revenues come through that way. Looking forward to continued volatility for the rest of this year around geopolitics, around Donald Trump, around all this kind of, confusion and uncertainty around geopolitics. But is that still going to be a slight drag maybe on IB?
There's a huge story underpinning the surface here. Matt was pointing this morning to Lazard shares soaring on the back of a lot of this optimism here you're seeing in the big banks. Centerview, the Wall Street Journal had reported that they're considering options. This would be the year to go public, isn't it?
Well, I'm not the advisor here, Sonali, but maybe you can tell me. Maybe we can phone up Blair Efron and have him on TV and he can tell you that. But, without that, yeah, who knows?
So the other thing about this, too, is even though you have stellar results right now, does it seem like they can keep going? Where are the rest of the profits going to be coming from through the rest of the year? I think for Citigroup and JP Morgan in particular, people are so excited about Wall Street. Are they looking at Main Street enough?
Yeah, well, I mean, that's true. I mean, I think a lot of the revenue guidance that's pretty strong today, I mean, Citigroup's revenue guidance for this year is above what analysts were expecting them to say, even though costs are going to be sticky, pretty much flat, slightly down maybe. We are looking at revenue guidance that's coming through this year pretty strongly. Yeah, on the consumer credit side, the sounds are still pretty optimistic. They are looking at modest growth in this in this space too, but I don't think it's going to be outperforming the more institutional side of these businesses.
Yeah, glad we could get you away from your computer for a little bit, Todd.
Thank you, Matt. It's good to be here.
Did we do enough?
We did. Okay, I'm done. Mic drop.
You don't
we're
need more
over.
time?
The thing about it is we're not even done yet. And this is the unofficial kickoff to earnings season. I know 2 weeks from now, we're really watching those big numbers come down from the tech companies now.
All right. We will be watching, $22 billion, $1 trillion in market cap instead of just 3. Todd Gillespie covers the banks. He's been at his desk since 5 a.m. without moving, so it's great that we could get him on TV for a little bit. Let's get a quick check on markets. That earnings optimism, as well as really a cooling inflation number, really boosting equity indexes. The S&P 500 up 1 2/3%, 5940 basically, so just 60 points away from hitting 6,000 again. And you can see that the 10-year yield has come down pretty substantially, 13 basis points. At one point we were off 15, which Sonali tells me is the biggest drop since August. So that's a real move there, but still at 466. Coming up tomorrow on Open Interest, ChargePoint CEO Rick Wilmer joins us, and Halozyme Therapeutics CEO Helen Torley.